my great pleasure to moderate this panel on Web3 and financial services. My name is Bryan Zhang. I'm a co-founder and the executive director of the Cambridge Center of Alternative Finance at the University of Cambridge Judge Business School. And over the last 8 years, we have had the privilege of collaborating with over 5,000 fintechs and more than 300 central banks and other security regulators to create high-impact research and to inform strategic market development, sustainable industry growth, and importantly, evidence-based regulation and policy making. So joining me on stage, we have an esteemed panel with a wealth of experience. First, we have Umar Farooq, who is the CEO of Onyx by JP Morgan. And Onyx was founded in 2020, and Onyx pioneered the world's first bank-led blockchain platform to facilitate the exchange of value, information, and digital asset. Pleasure to have you, Umar.
Thank you for having me.
Okay, next we have, sitting on the right-hand side of Umar is Staci Warden, who is the CEO of Algorand Foundation. Algorand is a pure proof-of-stake layer 1 blockchain, and the mission of the Algorand Foundation is to enable an inclusive, decentralized, and borderless global economy at scale based on the Algorand blockchain technology. Thank you so much for joining us, Staci.
I'm glad to be here.
Okay. Next, we have Jonathan Hayes, who is head of development for digital assets at Julius Baer, which is a leading Swiss private bank, where Jonathan is driving his digital transformation agenda, especially in regard to digital asset. Pleasure to have you, Jonathan.
Thank you very much, Bryan. Thank you.
Okay, and last, certainly not the least, on my right-hand side, we have Ebru Pakcan, who is the Chief Executive EMEA, Emerging Markets at Citi, and she is leading the bank's work in Europe, in the Middle East, and in Africa, serving clients in 59 countries. Pleasure to have you, Ebru.
Thanks, Bryan. Great to be here.
So collectively, this panel, we hope you to take on our journey in the next 37 minutes to understand a bit more about the dynamics and interrelationships between Web3 and financial services. So on that note, why don't we start with the question of a definition. So as we all know, the very concept of Web3 can be fussy and can be elusive. Some define it by the degree of decentralization or centralization. Others define it by the suite of underpinning technologies. So my question to the panel is, what is your definition of Web3 and how does it relate to financial services? Staci, why don't we start with you?
Okay, terrific. So there is a common definition of Web3, which says that Web 1.0 allowed you to access information, Web 2.0 allowed you to trade information, and Web 3.0 allows you to exchange value. And I think that's a very good working definition, and it's one that you will hear on every panel and every conference that you ever go to, is the definition of Web3. But what is really interesting is, what about that third piece? What does that mean to transfer value as Web 3.0? You can, if you are in Nigeria and you want to send a movie to somebody in Malaysia, you can do that in 2 minutes. You can do that over WhatsApp, a movie. But you can't send $10 to Malaysia without traveling through the correspondent banking system, clearing at the Fed, traveling back down the correspondent banking system, may or may not arrive, 10 days later, and somebody or multiple parties have taken between 5 and 9% off the top. That is the payment rails of our current financial system, which is not going to go away. But what Web3 enables you to do, and what blockchain enables you to do, it is not. Let me just put it this way. This is a bit of a glib statement, of course, but you could say that the history of financial innovation for the last 10 or 20 years has been about making those messages between bank balance sheets better. They're faster, they're more efficient, they're less costly, they're better. But blockchain is not that. It is not an improvement on that. FinTech is an improvement on that. Blockchain is different, and it is different from the ground up. And the way it is different is that it is one ledger. It is one ledger that multiple parties report transactions to. So there is no sense in which actually you are sending an algo back and forth, or you're sending a Bitcoin or an ETH, you are writing to one ledger. And a lot of things fall out of that, which I will, we'll talk about on this panel. But one thing is that if there is one ledger, it is very important that not one entity control that ledger. And so that is where decentralization becomes fundamental to Web3. The trust of that ledger has to be outsourced to the public square. And that is why decentralization is such an important component of the Web3 value proposition. But you can send, and I promise I will not do too much advertising on this panel, but you could send $1 million on the Algorand blockchain in 3.7 seconds and with under a penny transaction fees. And so that value proposition for payments is pretty enormous.
Thank you so much. Umar, please.
So I would agree on one thing, which is obviously the definition of being able to move an asset or move value as easily as you can move data today. So that's sort of like the high overarching. I do have to take exception to a couple of points. Obviously, one, I run the correspondent banking system for JP Morgan. So I have to say it doesn't suck that much, by the way. But we move about $10 trillion a night, every night. And a vast majority gets there within 24 hours with no fails, actually almost zero fraud on 10 trillion. So the systems work. That being said, I would agree that some of the cross-border transactions have some friction. They have friction, especially at the lower end, not at the higher end, but at the P2P end. And blockchain or Web3 could be a solution for that. So that way you can send money from a country to another country at low cost, et cetera. I also would take exception to the public square because the public square has given us some really nasty surprises over the last year. So I'm not as opposed to centralization, just given where I sit, obviously.
Can you send a 50-cent payment over JP Morgan Rails internationally?
On Ethereum, you can send 50 cents for $100, so that doesn't work either.
Right. On Algorand, you can send 50 cents for 0.001 cents. I'm just saying, I'm not saying it's going to replace traditional financial rules, but if you want to be in micropayments, which is a really important value proposition globally, you have to be in blockchain technology, not traditional.
I think it's primarily theoretical, but you can agree to disagree. So.
A debate. Yeah. That's what we like to see.
Yeah, you'll get that, don't worry.
Fantastic. Yeah. Jonathan, please.
I agree to the speakers so far in the definition. I think there's a room for a shared one as well as centralized ledgers. I think actually Jenny from Templeton this morning summarized the key attributes perfectly. So an open transaction ledger, platform for trusted computing in a verified way, which are smart contracts and an exchange of value. And I think all of this for financial services will be really a massive change. There will be a lot of innovation in use cases. There's a potential for efficiency increase and risk reduction.
Fantastic. Ebru, can I turn to you? What's your definition of Web3?
Well, I think I'm not going to comment on the definition. I do want to comment on what I think is superior in Web 3.0 versus 2.0, and that's around data and data privacy. Web 2.0 has actually enabled a lot of things, and we are all living in that environment as we live, but one of the challenges around the amount of personal data which is out there on the web, and it's a great concern for people. And what 3.0 is promising to achieve is data privacy and sovereign ownership of your own data, whatever you created, whatever your personal data, and how and when and under what circumstances and privileges you are allowing others to access that. I think that's actually game-changing. Now, there are issues with that. It's not perfect. That obviously creates challenges for regulators. And something that I'm sure we're going to pick on as we go along, but I think that's a superior attribute of 3.0.
Thank you very much. So, can the convergence of Web3 and financial services create new financial infrastructure and new value propositions, or simply enhance the existing ones? What are some of the hero use cases or killer applications that you have seen? For example, the tokenization of a real-world asset. So can I go to Umar?
So I think there's both aspirational future fully Web3 mechanisms that could show paths to where one day we could do. So for instance, some of the swap protocols are truly interesting, and they could change how financial services works, actually at a very high, sort of high-end, large value, FX type movements, in the wholesale world. But in terms of what is already acting, so for Onyx or for our blockchain team, which has actually been in existence for now 8 years, we do quite a bit of work on tokenization of assets. And we do things like, for instance, intraday repo trading. So the US repo markets are primarily overnight markets, but because we could tokenize securities, mortgage-backed securities, as well as money in the form of JPM coin, we can do now repo transactions for 5 minutes or 10 minutes or 2 hours. We can pick your flexible approach. Now, that might sound not super interesting, but you can just imagine if what happens to the velocity of capital if you don't have to borrow overnight and you can borrow for 15 minutes because you just need a flash transaction right there. So that thing has been growing from what used to be hundreds of millions to now several billion a day at times of trading between us and other broker-dealers. And I think it shows the power of technology bringing actually some of our peers together that probably wouldn't have done something like this together. So I think there's lots of use cases. On the pure Web3, as I said, swap protocols are interesting, lending protocols are interesting, but that will take some time migrating to financial services.
Thank you. In the hope to keep the debate going, Staci.
I'd like to disagree with everything that Umar just said. No, just kidding. So I think there's sort of a big 5 use case that I always think about. Number 1 is micropayments. Number 2 is self-sovereign identity. How many of you have daughters in the room? Okay. So in the United States, at least, why does a young woman need to go into a bar, and if she wants to have a drink in a bar, why does she have to give the bartender her address? Why does she have to do that? With a self-sovereign identity, you can not only compile identity from various information, but you can also release various components of that identity when it's fit for purpose, because all that bartender needs to know is that she's legal to drink in the United States. He does not need to know where she lives. That's the second piece. The third piece is what we call programmable money. And this is very simple concept, which sounds fancy, smart contracts, which just says, if something happens, then I will release this payment and have that done in an automatic way. A close kind of cousin of that is what we call an atomic swap. The idea that if all of the conditions of a payment are met, that payment and that asset can be transferred immediately. And so you don't have all of the kinds of settlement failure risk that he just talked about. And then last is, again, that Umar talked about, is this digitization, this tokenization of large, more illiquid assets. And that is, according to a very nice, which I recommend, Citibank report on the sector, is about a $16 trillion opportunity. That's trillion with a T. And so when we think about all, and that just has implications, I would say, not just for financial inclusion, but also for the liquidity of those assets. So what you're doing is you're bringing liquidity to markets, you're making sure that they are more efficient, you're helping provide the trust there because of the lack of settlement failure. And maybe the next time I have a turn, I'll talk about some of the examples of that are being built on Algorand, but I'll cede the mic for now.
Thank you. Jonathan, please.
I think we should really appreciate also the fundamental differences between the financial system we have today and Web3 or decentralized finance, if I might call it out, the development of the last 2 to 3 years. So while DeFi has been really rich in innovation, it has really fallen also short in any sense of financial responsibility if we speak about suitability, money laundering protection, and so on. The second factor with DeFi is that it's a completely isolated world where you can speculate in virtual assets, and it lacks any link to the real world of physical assets. And I think that's where financial services players could contribute, as Umar, you said, in helping to tokenize real assets and bringing them on-chain, or to help to enforce suitability. On the other hand, of course, banks are not really the most innovative, at least, I mean, they're differences, I think, but I mean, primarily banks are set up for stability and, to conduct business in a regulated manner. And so here I think that financial services players can profit from the decentralized finance ecosystem and bring more innovation to the offering. But I think it's going to be a long process and not anything where we can immediately accept any application.
Thank you. Ebru, please.
Well, the great thing about being the last to answer a question, you can actually answer with whatever is remaining. But I'm gonna just touch on trade and trade finance. In my role, I'm managing a business across all of Middle East and Africa, and commercial trade is the cornerstone of economic development for many of the countries and many of the SMEs, MMEs, as well as large corporations. If you bring together the 3 different building blocks, distributed ledger, smart contracts, and digital assets, the world of trade finance dramatically changes. In many of the markets where we are operating, one of the big challenges of our clients is around document movements, document validity, authorization by various different authorities in the market, which are export controls, foreign exchange controls, etc., etc. When you bring all of those building blocks together, you can actually really leapfrog and bring very different velocity, very different cost, and very, very different non-fraudulent activity capability into trade finance. And that's hugely, hugely important for economic development and progress. And that's what I get very excited about.
Fantastic. Stay on that point, if I can stay with you. So trust remains the foundation of financial services. Given the events of the past 12 to 18 months, or past 12 to 18 weeks, both in the digital asset space, but also in the traditional banking sector, how can Web3 enable the financial services maintain or enhance that trust, not to undermine it?
Well, look, we talk about responsible finance, or we've been talking about responsible finance and how to ensure there is accountability and responsibility that goes with that. In the traditional finance space, there is more work to do there. But as Web 3.0 is getting out of the gates, it's very important to think about how to work on responsible digital asset development, responsible Web 3.0 development. And that's going to be a huge challenge for not only governments, but for the society as a whole. How will the society hold such development responsible and accountable? The most recent examples are showing us that the most vulnerable are likely to be the consumers, the likely who are already challenged with lack of financial inclusion otherwise. And therefore, I think coming up with regulatory frameworks, not waiting until the world to perfect itself, but to be able to come up with regulatory frameworks early on is hugely important. And that's one of the things that some of the governments, some of the regulators has been actually pioneering. Here we are in the UAE. Different regulatory bodies in the UAE have been collaborating to actually pioneer that here. We have various other examples in Asia. I find that in many of the developed markets, the regulators are actually slower. They are trying to understand the whole picture. They're trying to worry about all different components. The challenge with that, in my mind, is the innovation is not stopping. The innovation continues. So the later the framework comes, the more exceptions are actually evolving and growing. So I think moving fast is important.
Thank you. Staci.
I think that the global financial system has built up a large infrastructure to build trust, because you need you need to trust your counterparty, and if you don't, you need escrow, for example, and you need all of these things. You need to trust your central bank not to inflate away the money supply, et cetera, et cetera. And it is no coincidence that when Satoshi Nakamoto wrote her first paper, she did it in the back of the global financial crisis, because at that time, the thought was that central banks were going to inflate away their debt. There was a lot of sovereign debt. Central banks would, of course, just inflate. That did not happen. But the idea of a Web3, a blockchain-based environment, is that it, in part, and I don't want to overstate this, of course, it obviates the need for trust, because, again, the public square that is that shared ledger is run in a kind of by everybody that participates in it. And the automaticity of code and the idea that code is law in a Web3 environment makes it so that you don't have to trust your central bankers to do the right thing. And the thing about Bitcoin is that the monetary supply dynamics are hard-coded in, and so you don't need the same kind of trust that you do. Now, the stuff that has happened this year in crypto, I would argue, is really just about fraud. It's fraud like you'd see anywhere, just happens to be around digital assets. But fraud is fraud, and fraudsters are fraudsters, and it's very important to go after those people wherever they are. But DeFi, programmable money, held up as advertised during both the Terra Luna crisis and during the later crisis in the fall with SBF.
Umar, please.
So I think it's a bit of a nuanced question, because I think if you are a technically extremely savvy person, I do fully agree with Staci that, I mean, I think
Again?
Yeah, I mean, this, you're an ex-JP Morgan person, so I have to agree once in a while. But, I think, as ex-colleagues, but you basically can understand what's written in the code. Yes, you can trust the code, and you can read it, and you can see where Bitcoin, programs the 21 million limit, et cetera. The issue is the vast majority of users are just not tech savvy. And so how do you bring trust in? I always say, like, banks are, by the way, fundamentally in the business of trust, not anything else. And we have regulators who are also in the business of trust because they make sure the banks can be trusted. And despite that, and having hundreds of years of history, banks continue to find ways to screw that up, like on a regular basis. So I think there's a long journey to go, and regulation is key, as was mentioned earlier. And clarity in regulation is key, because otherwise people just, even for user experience reasons, will continue to default back to CeFi to interact with DeFi. Because no one wants to keep their phrase, like if you're a regular person, then you miss your 2 words and now you've lost all your money. I mean, that's just like not how normal people want to operate. So I think that's the reason why, without proper regulation, oversight, clarity at a global level, you will continue to run into, whether that's fraud on purpose, or whether that's frankly just like people screwing up the code or not being thoughtful about it, because there's a bunch of junk out there too, and you just fall in those traps.
Yeah, let me just piggyback on that, because I think it's a really important point. And the most dangerous thing is when people use kind of skeuomorphic words, like words that mean banking words. So when these crypto-adjacent protocols that are actually very centralized, they're run by people, they start using words like yield and custody, which means something in a regulated environment. Yield means something, so does custody. And so when they pretend that they're like banks, and they pretend that they have those kinds of regulatory safeguards, but they also pretend that they're in crypto, is a very dangerous place. And that's where a lot of the trouble happened in this past year.
Great, that's a great point. Jonathan, please.
A founding principle of crypto is don't trust, verify. So the full idea is, to do away with intermediaries altogether, I would say, and even to have to trust and do your own research. And frankly, I mean, I don't want to come across as a crypto skeptic, because it's close at heart. Still, I have to say, in all honesty, I think this principle in its extreme form is really wrong. And the reason, number one, is it's very hard to do your own research, and it's very hard to really assess a protocol. So we had this recent DeFi protocol, which got hacked after, 6 security audits or so? So it's one hard. Secondly, I think it's important to remember there's really a big asymmetry in the payoff. So if I'm a normal guy and I look at even the source code of a smart contract, supposing I could do it, the best thing which could happen is that I find out it works as intended. However, if a malicious actor does the same, for him, he could potentially drain the protocol of all the money it ever interacted with. So he could make off with a huge sum of money, and that's this asymmetry which I see. So in conclusion, I think crypto will not do away with trusted intermediaries. I think it will replace intermediaries in some very important functions. But by and large, I think there's a role for financial services to play to act as some trusted intermediaries.
100%.
Thank you. If I can stay with you, what do you think are some effective mechanisms to drive the adoption of Web3-based financial services and to forge meaningful collaboration, right, between DeFi, CeFi, and TradFi ecosystem? Is that consortium model? Is that public-private partnerships? What are your thoughts?
At the moment, this is, in all honesty, very difficult, because for banks, and again, representing a bank here, you really have to vet very carefully the counterparties with you work with. And it's not enough that, someone is, a protocol or something which seems to be okay with all regulation. I mean, if there is an enforcement action in the future, and that's why regulatory ambiguity hurts so much. So if there's any risk for such enforcement action, a bank will not engage in a contact. So I think this regulatory clarity is super important. What I can briefly share is that, being a bank in Switzerland, for example, we cooperate with other banks on the question of a tokenized Swiss franc or a stable coin of a Swiss franc. That's a consortium of banks. I mean, to be sure, it's just in a concept phase right now, but we feel it's something very, very important which we could potentially contribute to the Web3 ecosystem to have a safe and sound form of money.
Thank you. Umar, please.
In terms of building things, I find public-private partnerships are going to be pretty critical here. both from funding point of view, from a regulatory point of view, how to push these things forward. I am a little bit wary of large consortia, though, because I laughingly call it the reverse Metcalfe law, which is you put a bunch of banks in a room and the chances of something getting done, go down pretty exponentially from there, just because everyone makes everyone else much more conservative. So I do feel like, especially in the core infrastructure space, banks, non-banks, central banks will have to figure out how to operate and how to build global infrastructures that actually can work and have the right characteristics. Some of those could be existing, some of those could be new. So I think that's how this would get, sort of pushed forward. I don't think you're going to win in a purely DeFi world or a purely CeFi world. That's just not going to work.
Thank you. Ebru.
So look, there are so many different models which are emerging. I don't think it's right to say one model is superior to others. I think what is critical is to be able to create environments which allow for experimentation. And that's not easy. When you start working with financial services, experimentation can lead to issues. So the collaboration then between the public and private, I think, becomes very important with appropriate regulatory sandbox which are being created so that people can actually experiment freely in a controlled manner. Because as with everything else, there is a lot that needs to be learned, and there is a lot that still needs to be solved for before masses of trillions can actually start going through the pipes. On the experimentation point, the other thing that I wanted to mention is I think we need to be careful that not every step which is taken is not immediately going to be like critically successful. There are a number of central banks out there who have issued their central bank digital-backed currencies. And people are out there criticizing the volumes are very low. When is it ever going to reach the masses? It's just a building block. It's just a building block. Innovation now needs to be built on top of those tokenized digital currencies to be able to actually make more meaning out of them. So again, innovation takes time, and it will have some failures. How do we create that sandbox and experimental environment, and how do we give it the right amount of time for it to be able to scale?
Thank you. Staci, please.
Well, since you said you were going to ask this question about what do we need, and I'm all about asking for what I need, I actually made a list. We need guarantees of security. We need guarantees of privacy. We need an ability to get to scale. We need on-chain identity. We need interoperability. We need easy user interface so that people don't even know that they're using blockchain. I mean, I don't say, Umar, did you get my email I sent by HTTP the other day? Like, nobody even knows how that works. And we need smart contracts to have a better legal basis. Now, when you think about those things in a bit slightly more technical level, it's making sure that we have things that we can trust, like good oracles, good zero-knowledge proofs, so that you can attest to the veracity of something without having to give away exactly how you did something or exactly how you know it. You can still attest that it's true. We need secure bridges so that we can go back and forth between blockchains, which has been one of the greatest source of hacking in the last year. We need, again, decentralized digital identity. And we need to digitize the workflow from start to finish. I mean, to the extent that Umar can't get done what he needs to get done, it's because pieces of his workflow are not digitized. It's probably somewhere where he has no control over it. And we need tech-neutral laws. And we need a regulatory environment of the kind that Sapnendu said in the very good panel before us, where the regulators get in there with you, get their hands dirty, help drive forward public-private partnerships that can make this work so that this set and series of technologies can work in the best way for everybody.
Thank you. So, Umar, I have a question for you. So what form of money do you think will flourish in Web3 and even in the metaverse? Would that be crypto asset, stablecoin, CBDCs, or even tokenized bank deposit? And any insights you can share from the Project Guardian that JP Morgan conducted in collaboration with the DBS, IBS, and the Monetary Authority of Singapore? Thank you.
Okay, so as far as, I'll start with Guardian. So we did some work, and we've been, by the way, partnering with the MAS for actually better part of half a decade with Sapnendu's team on various things. We have a company called Partier that was created out of that, which essentially is designed to change the face of correspondent banking over time between us and 3 other banks, as well as Temasek. And then with Guardian, we were really looking at how do you take a bank liability, which is a deposit, and put it on a public chain. And so we tokenized deposits, which again, still legally unclear, so we had to do a bit of a sandbox thing. Tokenize deposits out of Singapore, put them on a Polygon chain, and then we used verifiable credentials, which is on-chain identity issued by us, and it was SBI out of Japan, to do swaps between yen and Sing dollars to kind of show how, in a Web3 context, actual existing legal regulated liabilities of banks would operate and how they could go back and forth. So I think and that was because we do believe that longer term in the Web3 space, tokenized deposits is going to be one of the major forms of money. And I think if I had to say of the four that you mentioned, I think CBDCs could be there. Again, the question is like how they get built, what they are, retail or wholesale. Especially for wholesale CBDCs, there's actually really strong value propositions in terms of being able to trade and in terms of being able to clear and settle large equities, et cetera, in certain geographies. Tokenized deposits would be there because if Web3 becomes a real live ecosystem, we will be moving tokenized deposits because that's from a capital point of view, the most efficient thing banks can do on Web3 space. I think stablecoins most likely will be there in some way, shape, or form, but I think of stablecoins as just one more rail for value exchange. Crypto assets I find harder to kind of swallow, not because there's something inherently evil about them, it's just that there's still too much volatility. And I think unless people like paying in a currency which is written in the grocery store. Like when you go and want to buy bread, it should just say like, this is like $1, and then the dollar doesn't change every 3 minutes. So that's sort of mechanism, my view is cryptocurrency is probably a harder one to see as money, not as value, but as money. But the other three could coexist easily.
Okay, thank you so much. So Staci, looking forward, would the public blockchains underpin and power the financial activities of Web3 world, or will private permissioned blockchain coupled with digital infrastructure provided by the big techs such as Meta and Google dominate?
I think there'll be a place for both. I think it's interesting that the ecosystem kind of started with private blockchains, and not very many of those are doing very well right now. So I think there'll probably be some natural gravitation to a public blockchain, but there's definitely going to be room for both. But let me just list, if I can, just a couple of things that are happening on Algorand blockchain, because this is just what I know. For example, we are working with a couple of big disaster relief organizations in the United States, St. Vincent de Paul, the National Association of Voluntary Disaster Relief Organizations, because disaster relief organizations in the United States, they show up on site with tens of thousands of dollars in prepaid debit cards and hand them out. It's the most ridiculous thing. And the money needs to get there quickly, but it's also rife for fraud, and it's taxpayer money, so the diligence on it has to take time, but the people need, right now we have this app called the CARE, C-A-R-E app. You take a picture of your flooded living room, all of a sudden the money arrives, your Amazon list, your credit card, you can spend it in Home Depot or Amazon immediately. But also the disaster relief providers know that you didn't just tap FEMA Texas and also FEMA Florida at the same time and are trying to double dip. This is the kind of thing that is game changing for disaster relief payments. I was just at the Milken Institute Global Conference, and Snoop Dogg was there, one of their keynote speakers, and he was up there. I mean, this guy's a very wealthy guy, and he just had a rant, which you should listen to, about the streaming music service. He says, you're streaming our music. We have no idea. I used to sell records, and I used to know how much money I would get by how many records I sold. Now I have no idea how much money you're making on me and what percentage of that is mine. So the newly reconstituted Napster is also it happens to be on Algorand, but it could be on a different blockchain as well, of course. But it's on Algorand, where artists will know on Napster now how many times, because it's on the blockchain and it can't be messed with, how many times their music has been paid. And the list just goes on and on with these kinds of things. Micropayments, carbon credits. Everybody's talking about carbon credits, but they're always at the industrial level, right? But there's somebody building on Algorand who is doing household carbon credits. If you put a solar panel on your roof, you can actually collect money, so it's an income source for low-income households. And these are the kinds of things that make me very excited about the future. And again, tokenizing assets, rental incomes. You can tokenize rental properties. Lofty AI, something built on Algorand. You now can have a rental income stream, which is something in the United States was only available to large-scale accredited investors. Now you as an individual can co-invest in a rental property and get some rental income, and by only investing like $20. I mean, this stuff is just amazing for financial inclusion.
Thank you. Jonathan, how do you see the increasing adoption of digital asset transform the private banking and wealth management industry?
I think the convergence of Web3 and financial services will by no means be quick, but it will be all the more transformational and massive, actually. And I give some examples for this. Perhaps, firstly, we spoke a lot today about the tokenization of assets. So this expansion of the asset universe will, of course, be a great opportunity for wealth management. Secondly, through decentralized finance, a lot of new interesting economic mechanisms and payoff structures have been invented. I think, again, this is something where wealth managers will have ample opportunity to put that to the advantage of clients. Thirdly, and perhaps most importantly, actually the mechanisms of blockchain could lead to a breakup of the integrated value chain, which we in banking enjoy so far. So where you custody your assets is also where you get advised, for example. This might, of course, break up, and it could be a threat to private banks and wealth managers, but also an opportunity, for example, to start advising on assets which are held elsewhere. The immediate opportunity, however, I would say, and that's relatively clear in the presence already, is enormous wealth creation through crypto, be it through speculators, through entrepreneurs, and so on. So we see more and more people with an interest to actually bring their crypto wealth back to the normal world.
Thank you. So Ebru, Governor said this morning, right, 40% of the population in MENA are still unbanked or underbanked. So how can Web3-based financial services advance financial inclusion at the same time not lead to financial exclusion, especially for a region like MENA?
So let me step back by saying at Citi we have a $1 trillion financing objective for environmental and sustainable financing. That obviously is following UN's ESG objectives. And a big ticket part of that is, of course, financial inclusion. Now, that objective of $1 trillion, of course, there's going to be some big ticket item financing through climate transition all the way to other environmental financing. But when you think about sustainable financing, it's very important to think about the broader supply chains, entrepreneurs, all the way to SMEs, all the way to MMEs. Now, thinking about Web 3.0, today, if you're a small, medium enterprise, you don't really have access to funding or financing in the way that a large corporation does in the capital markets. But with the advance of 3.0, you have the option of being able to have tokenized equity calls, digital bond issuances, things that actually don't exist for an entire segment of companies or small enterprises. So unlocking that is a huge opportunity. And I'm touching that specifically because when people think about financial inclusion, a lot of people think about the consumer and the unbanked, and no doubt that is an opportunity. But there is an entire segment of important economic drivers that can be powered by the new technologies, and I think that's something where we have to really focus our energies.
Fantastic. We have 2 minutes left, so let's have a quick firing round. Last question. So Dubai is due to host the COP28 later in the year. So in what way do you say Web3 based or Web3 enabled financial services can be part of the solution to help us move towards a greener and more sustainable economy? Let's start with you, Staci.
I think the recent move to proof-of-stake blockchains is a really important. Algorand, it takes the same amount of energy as powering a Tesla for a year, and Ethereum made a very big move to move away from a proof-of-work to a proof-of-stake blockchain. I think that's very good for the environment. So I think we're going to shed this idea that blockchain is not environmentally unfriendly going forward, at least for non-Bitcoin blockchains.
Umar, please.
I believe some of these assets that are going to get created, whether they are carbon credits, which already exist, other sorts of, sustainability-linked assets, ESG-type investments or capital raising, all of these things are fundamentally new types, and they are relatively illiquid, they don't have existing infrastructure. I believe them combined with tokenization on a blockchain where value can move, whether that's through tokenized deposits or some other mechanism, I think is really going to help hopefully progress the ESG agenda forward. Jen.
Thank you. Jonathan, please.
Yeah, I think there's a lot of, all of these sustainable development goals need collaboration in some form or another, and blockchain can be a great use case for that, be it provenance tracking, be it tracking of carbon credits, and so on. Just back to the electricity question, I mean, obviously the proof of work, proof of stake transition is a great one, but also let's bear in mind that we should not filter our choice of technologies right from the start if it, meets all our beauty criteria. Sorry if I'm too cynic here, but I would just like to remind, with all the love AI gets at the moment, AI algorithms are trained with lots and lots of computing power. And actually, from that point of view, I mean, many of the problems we now use ChatGPT for could be just done by a human brain, whereas we like to use a lot of electricity for it.
Thank you. Ebru, we have the last word.
I'm just thinking whether there is a solution to greenwashing, which is one of the problems that COP28, I'm sure, is going to be thinking about trying to solve. How does Web 3.0, with its wider distribution and with its trust capability, actually solve for that data collection and data validation challenge?
Thank you. The time flew by. We're at the end of the panel. I hope you enjoyed this fantastic panel discussion. Please join me in thanking our fantastic panelists, Staci, Umar, Ebru, and Jonathan. I hope you enjoy the rest of the Dubai FinTech Summit. Thank you very much.